today's our topic is we are going to start a new very big standard. Just like IFRS 16 took 3 classes, so this financial instrument is also very big standard, and the name of this standard is IFRS 9 financial instrument. IFRS 9 financial instrument. Okay, and we are starting it with a practical area, very different practical area. Okay, there are theoretical aspects. There are theoretical aspects as well in this IS, but today's whole class we are devoting only for this practical area. Okay, and it's very interesting. So, and it's all logical. So let's start. Just think. Just I'm sure screen is clear in front of you. Just think. Today I was out of money. I was running out of money. I didn't have cash. So I went to a person and I asked $1,000 loan. I asked $1,000 loan from a bank or from somebody. Okay. But I said one thing. I said I don't have cash to pay liquid position. I don't have cash to pay you a physical interest. I can't pay you interest annually. I can't pay you interest annually. You know what that other party said? Okay, we don't want any interest. We don't want any interest. They said, okay, we don't need any interest. You are taking loan today. You are taking loan today of $1,000. No need to pay any interest. But after 3 years, when you will come to repay back the loan, then pay us a redemption premium. He used a new name, redemption premium. Pay us 1,000 plus 331 redemption premium. 1,000 plus 331 is the redemption premium. This is a new name. Redemption premium of 331. He said, no need to pay interest. You are taking 1,000 now, and you are not paying any interest, leave it. We don't need. But at the time of redemption means repayment. Redemption means repayment. At the time of redemption, that means at the end of year 3. At the end of year 3, pay me 1,000 plus 331 extra in the name of redemption premium. Redemption premium, extra amount at the time of redemption. I immediately understood it, that this is interest. He just changed the name. He just changed the name of interest. He used the word redemption premium. In reality, this is interest. in reality, this is interest. Just think, we took the loan of 1,000 and we are repaying it 331 extra. So this is nothing but interest. So now always remember, redemption premium is just by name redemption premium. In economic reality, it's interest, and interest is an expense, and interest is an expense. And you know, expenses are recorded when they are utilized. Expenses are recorded when they are incurred. So as we have used this loan for 3 years, as we have used this loan for 3 years, that's why we need to spread. That's why we need to spread this redemption premium over the life of loan. Over the life of loan, because this is interest. Okay. So now I will be spreading this redemption premium over the life of loan. Now, how will I spread this redemption premium? Through effective interest rate. Through effective interest rate, which will be given ready-made in the question. Which will be given ready-made in the question. Okay. Now wait, just have a look. Now at day zero, at day zero, at day zero, how much loan I took? I took loan of 1,000. At day zero, I took loan of $1,000. $1,000, right? So what's the entry when we take the loan? We receive the cash. So bank debit and loan credit. This is the first entry. Bank debit and loan credit. This is the first entry. This is the first entry. Okay. Now, what is the effective interest rate? 10%. Effective interest rate is 10%. So we need to book interest expense at the rate 10%. Now, just think, see the story. How much loan we used in the first year? How much was the outstanding loan in the first year? Is 1,000. That means in the year one we use 1,000 loan. So 1,000 times 10%. 1,000 times 10% is how much? 100. So we should have made the entry. See, debit interest expense 100. Now use your brain. Are we going to pay this 100 now or after 3 years? Are we going to pay this 100 now or after 3 years? Obviously after 3 years. No physical interest in this question. After 3 years. So this loan, this interest will be part of the loan. This interest will be part of the loan. So we'll credit the loan. We'll credit the loan. Now just think, what was the original amount of loan? What was the original amount of loan at year 0? It was 1000. At year 0, the original amount of loan was 1000. 1000 plus 100 is 1100. 1000 plus 100 is 1100. Okay, so at the end of year 1 your loan is updated to 1100. At the end of year 1 your loan is updated to 1100, right? Now you have studied compound interest. This is same as the case. Now in the year 2, what is the outstanding loan? Use your brain. In the year 2, the outstanding loan is 1100. That means for the whole year we use the amount 1100. So now the effective interest rate is 10%. 1100 times 10% is 110. So this entry will be interest expense debit 110. And again we are not paying any interest right now, we will pay in the end. So this will be the part of loan. This will be the part of loan. Okay, so 1100 plus 110 is, my dear student, 1210. 1100 plus 110 is 1210. 1100 plus 110 is 1210. 1100 plus 110 is 1210. Okay, now the third year, see. Now, what is the outstanding loan at year 3? What is the outstanding loan for the whole year 3 is 1210. 1210. Let's multiply it by 10%. 1210 times 10% is 121. So the entry will be debit interest expense 121 and credit loan 121. Now be very active, be very active. Listen, at the beginning of year 3, listen, at the beginning of year 3 the amount was 1210. At the beginning of year 3 the amount was 1210, and we just added 121 in it. Come on, add it. 1210 plus 121, exact dot, sharp and dot, 1331. See, the story ends at 1331. The story ends at 1331. That means at the end of year 3 at the end of year 3 we have to pay 1331. At the end of year 3 we have to pay 1331. Okay, so finally we have to pay this amount of loan. Finally, as per agreement, we have to pay 1331. So we'll take out cash from our pocket and we'll throw 1331 to other party. So final entry will be debit loan 1331 and credit cash or bank 1331. Debit loan credit cash, debit loan credit cash, debit loan credit cash. Just see the full picture now. Just see the full picture. Now I have a question. Our objective was to spread this 331 over the life of loan. Our objective was to spread this 331 over the life of the loan. Over the life of the loan, our objective was to spread this 331 over the life of loan. Just see and use your cal. Did we spread it? Yes. In the first year, how much we booked? In the first year, how much we booked in the P&L? See, 100. In the second year, we booked 110. In the third year, we booked 121. In the first year, we booked 100. Second year, 110. And third year, 121. Can you add these three? Yes, the total is 331. So that means we have spread this redemption premium over the life of loan. We have spread this redemption premium over the life of loan. And my dear students, this is exactly the application of matching principle, because we use this loan for 3 years. We use this loan for 3 years, so it's very logical to spread the cost, and redemption premium is a cost over the life of loan. And we did that. Okay, And we did that through effective interest rate. Don't forget, we did that through effective interest rate. This is the first question. Now, just a little amendment to the first question. Little amendment to the first question, and listen very carefully. It's very interesting stories. Now, once again, we were out of cash. We had some cash flow issues. So I went to a bank and I asked them, listen to me, I asked them loan $1,000. They said okay. And now I know that the market interest rate is 10%. I know this fact that the market interest rate is 10%. But you know what I said? I said, I can only pay you 5%. I can only pay you 5% annual interest on this $1,000. And I know that the market interest rate is 10%. You know what that guy, the bank guy said? Okay, okay. You can pay 5% every year. You can pay 5% every year, but after 3 years, when you'll come to repay the loan, after 3 years, when you come to repay the loan, you not you don't have to pay only 1000. Not only 1000 you have to pay, but also 165.5 extra. See, in the end you have to pay 1165.5. In the end you have to pay 1165.5. That means 1000 plus 165.5. And he gave the name again, 165.5 as redemption premium. As redemption premium. So I immediately understood the game. I immediately understood the game, that whatever he gave discount in the starting, he's charging in the end. Just think, the market interest rate was 10%, and he gave me loan for 5% annual interest. That means the remaining 5% this guy will charge in the end. The remaining 5% this guy will charge in the end in the form of redemption premium. So once again, it is proved that redemption premium is just by name. The name is just redemption premium. Economic reality, it's interest. In economic reality, redemption premium is interest. In economic reality, redemption premium is interest. Okay. So now again, we have to spread this redemption premium over the life of loan, because we are using the loan for 3 years. So all cost must be spread over the life of loan. Now, one very interesting fact I want to teach you. Now, from now onwards, we will have physical interest, annual interest in the question. How to calculate physical interest? This is the universal formula. See, physical interest is face value of loan multiplied by coupon rate. This is the formula. Whenever you are asked to calculate physical interest, this is the universal formula. Face value of loan multiplied by coupon rate. Face value of loan multiplied by coupon rate. Face value of loan multiplied by coupon rate. Okay. Now, as per this question, the face value, the starting value is $1,000 times 5% is the coupon rate. So 50 is the fixed interest, annual interest for all 3 years. Okay. And don't forget, once a physical interest is calculated, it will be used in every year, in each and every year. Okay. Once the physical interest has been calculated, it will be used throughout the life of loan. Now, now just think, in reality, the effective interest rate, look at the question, effective interest rate is 10%. Effective interest rate is 10%, but we are just paying 5%. So the difference of this 5% is because of the difference of the 5% is because of the coupon rate, because of the redemption premium, right? I repeat, In reality, the if market interest rate, the effective interest rate is 10%, and but we are paying right now 5%. So the remaining 5% we'll pay in the end in the form of redemption premium. So no issue, no matter, we are paying it in the end. But according to the matching principle, we are using the loan over the life. We are using the loan now. So definitely we need to spread, we need to book expense from now. So don't forget this thing. In each and every question we are going to book interest expense, we are going to book interest expense using effective rate. Okay, so now let's start the show. First of all, on the day one, how much loan we took? On the day one, how much loan we took? We took loan of 1000. We took loan of 1000. Okay, so the first entry should be serious bank debit and loan credit. Okay, now in the year one, whole year one, our outstanding loan was 1000. What is the effective interest rate? Effective interest rate is 10%. Effective interest rate is 10%. So 1000 times 10% is 100. So you will debit interest expense by 100. Okay, now this question is different. In each and every year you have to pay physical interest every year. Now that is 50. So cash will be credited 50. And now again use your brain, little brain. Out of this, the real interest is 100. Out of this 150 you are paying now, 50 are you are paying now, and the remaining 50 you will pay in the end in the form of redemption premium. So remaining 50 will be part of your loan. Remaining 50 will be part of your loan. Okay, now use your brain. How much was the loan at the beginning of the year? How much loan was there at the beginning of the year? $1000 plus 50 will make you 1050. Your updated loan at the end of year one is 1050. Your non-current liability is 1050. Okay, now what to do in the second year? Just use your brain. In the second year your outstanding loan is 1050 for the whole year. In the second year your outstanding loan for the whole year is 1050 times effective interest rate, which is 10%. 1050 times 10% is 105. Okay, and I just told you each and every year you have to pay fixed physical interest, same physical interest, 50. So cash 50, and what is the difference now? 55. 55 will be the part of your loan. 1050 plus 55, opening loan is 1050 plus 55 is 1105, right? It's 1105, right? Now let's do it for the third and the last year. Now 1105 times 10% times 10%, it's 110.5. Interest expense 110.5, 110.5. Okay, again the physical interest cash will be 50, and the difference is loan credit 60.5, loan credit 60.5, right? Okay, so now just update the loan. Opening is 1105 plus 60.5, 1105 plus 60.5, it will stop right exact 1165.5. It will stop at 1165.5, 1165.5. Okay, so in the end, as per commitment, you have to pay this loan, and exactly your loan stops at 1165.5. So you will put your hand in your pocket and you'll count the cash and you'll throw. So the entry in the end will be loan debit 116.5.5 and cash credit 1165.5. Cash credit 1165.5, loan debit and cash credit Yes, yes. Okay. So now I'm going to prove something. Now just be a layman. Just think, we took this loan for 3 years. We took this loan for 3 years. For this 3 years, according to me, we paid two costs. According to me, we for these 3 years, we bear two cost on us. There were two costs on us. Number one is redemption premium was one of the cost. Redemption premium was 165.5c. Redemption premium was 165.5, you can see. And the second cost is physical interest, which we paid. The second cost is physical interest, which we paid. So physical interest, every year we paid 50. Each year we paid 50 physical interest multiplied by 3 years. Each year we paid physical interest 50 multiplied by 3 years. So it's 150. My dear students, can you tell me how much is the total cost for 3 years? How much is the total cost for 3 years? 165.5 plus 150. 165.5 plus 150 is 315.5. This is 315.5, 315.5. Okay, so we go very easy. In these 3 years, this was the total burden. This was the total burden on us. This was the total actual burden on us, 315.5. Okay, right? Now let's see, we did correct it. We did this question correct or not. This cost should be spread over the life of loan. This cost should be spread over the life of loan. Now, in the first year, how much we booked in the PNLC? In the first year, we booked 100 interest expense. In the second year, it's 105. And in the third year is 110.5. I repeat, in the first year, we booked interest expense of 100. In the second year, we booked interest expense of 105. And in the third year, we booked interest expense of 110, 110.5, 110.5, 110.5. Can you add these three? If you add these three, you will get 31.5.5. You will get 315.5. You will get 315.5. Okay. That means you are doing right. We are doing right. Okay. And now one last thing. And we spread these costs through effective interest rate. We did all this magic through effective interest rate. Okay, right? We did all this magic through effective interest rate. Or some trainers also say, teach like this. They say effective, look, just listen, effective interest rate effectively includes the burden of all cost. I repeat, effective interest rate effectively includes the burden of all costs. So if when we use effective interest rate, all costs is spreaded over the life of loan. Yes, one question. Effective interest rate is ready-made given. Yes, yes. In your course, it is ready-made given. Don't worry. Don't worry about it. Okay, now one very special name of this accounting. Can you see we are spreading cost in these last two questions? We are spreading redemption premium over the life. It means this is the accounting of spread. We are spreading the cost, and spreading means amortize. Spreading means amortize. So internationally, the most famous name of this accounting is amortized cost accounting. Internationally, the most famous name of this whole accounting, what we are doing, is amortized cost accounting. The name of this accounting is, let me write, it's amortized the name of this accounting is amortized cost accounting. Very famous name. Now this is one question, extra question now, and this is for 5 years. This is for 5 years, 5 years. Okay, now I'll teach you, don't know, no issue. Listen, Before, in the beginning of this topic, I was teaching you through double entries. I was teaching you through double entries because we were beginners. But examiner never asked double entry in even in the final account questions. Even in the final account question, you are not even in the final accounts question, you are not required to make double entries. So we make these four columns. We make these four columns. Open your eyes. We make these four columns. The way we were doing leasing, the way we were doing leasing, you remember LAS, lease amortization schedule. The same is this schedule. It's not difficult at all. Just relax and listen. Look at the question. You will understand. Now, debt issued for 1000, debt issued for 1000, right? That means we took loan of 1000 today. The debt is redeemable at 1250. Now use your common sense. We are taking loan of 1000 today, and after 5 years we are repaying 1250. So how much is the redemption premium? How much is the redemption premium? The redemption premium is 250. The redemption premium is 250. Okay, now, and interest is paid at the rate 5.9% per annum. Interest is paid, that means physical interest. Physical interest is 9 point physical interest is 9.5 5.9% per annum. You remember I taught you just in the last question how to calculate physical interest. There is worldwide there's the same formula: face value into coupon rate, face value into coupon rate, face value into coupon rate, face value into coupon rate. So physical interest will be face value is okay. This is 59. Very simple, right? So just one time you need to calculate the physical interest, just one time, and it will be used for next 5 years. It will be used for next 5 years. Okay, go slow. Don't no issue. You will understand everything. Now, there are four columns I have made in front of you. The first is AC. A slash C means amortized cost. AC means amortized cost. I told you the name. Amortized cost brought forward. The second column is interest expense. Interest expense is calculated using EIR. EIR is effective interest rate. I taught you in last two questions. Interest expense is calculated using EIR, effective interest rate. Okay, right? And then the next column is interest paid. We have already calculated. And the last column is amortized cost carried forward. Amortized cost carried forward. Okay, have a look. Have a look. Now, just tell me how much loan we took initially $1000 loan, $1000 loan. So on the day one, we will be making this entry: bank debit, loan credit, bank debit, loan credit. So initial value of our loan is 1000. Okay, now just imagine this whole year we used 1000 loan. The outstanding loan is 1000. Tell me what is the effective interest rate? It's 10%. So 1000 times 10% is 100. Okay, now out of this 100, how much we have paid? 59. Out of this 100, how much we have paid? 59. Okay, so now 1000 plus 100 is 1100 minus 59. 1000 plus 100 is 1100 minus 59. 1041. Thank you. 1041. 1041. Excellent. This is the first year. Okay, this is the first year. Now, what is year two? What will happen in year two? 1041. 1041 is the closing of last year. So that means it's opening for this year, 1041. Okay. Now, in the second year, the outstanding, now it's very easy. It's number crunching, nothing. It's clerical job. In second year, you have to do 1041 times 10%. 1041 times 10% is 104.1. Again, the physical interest is 59. Can you simply 1041 plus 104.1 less 59? Update it, please. Update. 1086.1. Okay, and the year 3. Now the opening balance is 1086.1 times 10%, 108.61 less 59. Okay, now what's the closing balance of the third year? 0.71. Okay, now for the year 4, 1135.71 times 10%, how much? Less 59. Okay, sorry, I forgot. What is the closing balance? 1190.281. Now the last year, fifth year, 1190.28 times 10%, 0.28. No, 1190.028. Sorry, less 59. This will, the closing balance will be almost 1250. There will be a slight rounding of error. The closing balance will be almost 1250. You can check. There may be slight rounding of error, and it's very normal. Okay, so we got the target because in the end at the end of year 5 we had to pay 1250 as per commitment. So exactly the schedule is perfect. The schedule is perfect. Okay, now the student may ask, sir, you taught us in the way that we can verify the question in the end as well. You taught us in the way that we can verify the question as well. Listen, in this question again we had to bear two types of cost. Number one is redemption premium, and second is physical interest. Redemption premium and physical interest. Redemption premium was 250. Redemption premium was 250. Okay. Redemption premium was 250. And physical interest I think was 59. For 1 year is 59, so multiply by 5. 59 multiplied by 5 is 295. Okay, so physical interest for the 5 year is 295. Can you tell me what's the total cost? Can you tell me what's the total cost over the life? 250 plus 295. 250 plus 295, it's 545. 545. Now the most interesting part, 545 is the total cost of this loan for the whole 5 years. Total cost of this loan for the whole 5 years. Okay, now wait. That means which which column which column is gone in the PNL? Which column we took in the PNL this interest expense? Can you add this whole column? Can you add this whole column? You will get the evidence. Add this whole column, you will get the evidence. Do it if you want to do it. It should be 545. Okay, so this is the way we do it. This is the way we do it. Okay, you got it. Now, till now, what we have studied, that redemption premium should be spread over the life of loan. Yes, we all are agreed on it. And physical interest should also spread over the life of loan, and it is already spreaded. We pay it in pieces. We pay physical interest in pieces. Now, few things which I didn't tell you, now I'm going to tell you. There is one very special thing which we call discount, a new name, discount. There is one very special thing which we call discount. Now, wait, for yes, let me tell you a few words. The party who issues loan notes, the party who issues loan note is actually taking loan. Don't forget, these are basic things. The party who issues loan note is basically taking loan, and the party who invests in loan note is basically giving loan, is investing in loan notes. I repeat these words, listen. The party who issues loan notes is basically taking loan, and the party who invest in loan notes is basically giving loan to somebody. So now listen my example. Today we issued loan note with face value of 5,000. Today we issued loan note with face value of how much? 5,000. Okay, but listen, for attraction, we gave the offer to audience. We said, okay, we are giving you loan note with face value of 5,000. We are giving you loan notes with face value of 5,000, but you don't need to pay complete 5,000 now. Just pay us 3,000 now. We are giving you discount of 2,000. We are giving you discount of 2,000, means physical cash we received today is 3,000. Physical cash we received today is 3,000. Physical cash we received today is 3,000. Don't forget 3,000. Okay, but this is a constant thing worldwide, that when you go to repay the loan after 5 years, the minimum amount we pay is the face value. Face value is must repayable. The face value is must repayable. So just think at year zero, just see the economic reality, the inside of the transaction. At year zero, we took the actual cash loan of 3,000. At year zero, we took the actual cash loan of 3,000. But at year five, we are repaying 5,000. We took the loan of three and we are repaying five. We took the loan of three and we are repaying five. So just think, we are paying 2,000 extra. We are paying 2,000 extra on this loan. So this extra money is obviously interest. This extra money is obviously interest. So don't forget, listen, this discount is just by name discount. This discount is just a name of discount. In reality, this is also interest. This discount is just by name a discount. In reality, it's the interest. It's the interest. And my dear student, interest is expense. So in all expenses of this loan must be spread over the life of loan. All expenses of relating to this loan must be spreaded over the life of loan. Matching principle, because we are using the loan for 5 years. So now one more thing is added in our car, one more thing is loaded in our truck, this discount. Now discount which should also be spread over the life of loan. So three things till now: redemption premium, physical interest, and discount. These all will be spread over the life of loan. Now the last thing is issue cost. The last thing is issue cost. Issue cost. See, the last thing is issue cost. Now wait, let me give you one example. Today I raised a loan. I issued loan notes of $1 million. I issued loan notes of $1 million. Okay, but to raise this loan note I have to hire a lawyer. But to raise this loan I have to hire a lawyer, and I have to pay now issue cost of 20,000. Issue cost of 20,000 I have to pay. I have to pay issue cost of 20,000 to the lawyer, to the party, right? Now just think, what is the treatment of this issue cost? What's your advice? Should I book this issue cost immediately in PNL? Should I book this issue cost immediately in PNL? The answer is no. No. It will be against the matching principle. It will be against the matching principle. Why? You just think, why have we just think, why have we incurred this issue cost to raise the loan? To raise the loan, why have we incurred this issue cost to raise the loan? And now just think, this loan will give us benefit for 1 minute or 1 hour or 5 years. 5 years, this loan will give us economic benefit for 5 years. So that's why this cost should also be spread over the life of loan. This cost should also be spread over the life of loan, that is 5 years. So now don't forget, issue cost is also spread over the life of loan. Issue cost is also spread over the life of loan. So now total four things. Total four things: redemption premium, discount, issue cost, physical interest. All of them must be spread over the life of loan. Read this statement. Read this statement, please. Now, student may ask, sir, we need to do a question with all these four things. We need to do a question with all these four things, with all these four things, with all these four things. Okay. So now I'm teaching you this question with all these four things. Okay. And I'll teach you the technique as well, how to solve it. Now just look at that question. Face value of the loan is 20,000. Face value of the loan is 20,000 and the coupon rate is 4% per annum. Now don't go fast. Don't go fast. The first thing, let's calculate the physical interest. Let's calculate the physical interest. How we calculate the physical interest? The formula of physical interest is always in each and every question, face value into coupon rate. Face value into coupon rate. So face value is 20,000 times 4%, this is 800. So first of all, let's fix it. Let's fix this physical interest. Let's fix this physical interest. 20,000 minus in times 4% is 800. Okay, 20,000 times 4% is 800. Okay, now again read the question. Face value is 20,000. Coupon rate is 4%. Discount now at the time of discount is always given at the time of issue of loan notes. Please now don't sleep. Don't sleep. Discount is always given at the time of issue of loan notes. Okay. Then issue cost is $534. Issue cost is $534. Then redemption premium is 10%. Can you tell me what do you mean by redemption premium? Let me explain you. After the term is 5 years. Term is 5 years means after 5 years, at the end of 5 years, we will not only repay the face value of loan. Face value is mandatory. Repayment of face value is mandatory. That means at the end of year 5, we will not only will repay the loan notes, the face value of loan, but also a 10% redemption premium. So 20,000, 20,000 plus 10%, 20,000 plus 10% redemption premium, 20,000 plus 10% redemption premium is 2,000. So 20 plus 2, 22. So now don't forget this. Our table will stop at 22,000. Our table will stop at 22,000. Okay. Now they are asking financial statement extract. They are asking financial statement extract. Okay. Now let's start the question. Let's start the question. Let's start the question. Let's start the question. Listen. First off, it's a story. It's like a story. It's like a story. Now wait. Today, I issued loan notes with the face value of 20,000. I issued loan note with face value of 20,000. Okay. I issued loan note with face value of 20,000. But I didn't ask, I didn't ask complete money from them. I didn't demand complete money, complete 20,000 from them. I gave 2.5%. I gave 2.5% discount to them. Okay. So now just think, face value was 20,000 and I just gave discount of 2.5%. 20,000 times 2.5% is 20,000 times 2.5% is 500. So 20,000 less 500, 20,000 less 500 is 19,500. 20,000 less 500 is 19,500. 19,500. Okay. So wait, that means I issued loan note with face value of 20,000, but I just received cash of 19,500. Now, wait. This, let me tell you a story. It is my habit to count money. It is my habit to count money. So I was counting this 19,500. Listen, I was counting this 19,500. Suddenly the door opened and my assistant came. My assistant came, sir. I said, what? He said, I was counting the notes, the money, cash, 9,500. He said, the lawyer is waiting outside. Sir, the lawyer is waiting outside and the lawyer is asking issue cost. The lawyer is asking issue cost. Look at me. I was counting this 19,500. So I just picked up from this 19,500. I just picked up 534 and I gave to my assistant. Okay, give it to lawyer. Give it to lawyer. So now wait, out of 19,500, 534 is given to lawyer. 534 is given to lawyer. So 19,500 less 534, 18996, 18966, sorry, 18966. Okay, this is the amount. What, this is the actual cash we received on day one. This is the actual net cash we received on day one. And now open your brain, please. We'll start our amortized cost table with this net loan. We always start our amortized cost accounting with this net loan. Don't forget, whatever net cash we receive, whatever net cash we receive, we start our amortized cost table, amortized cost accounting with this. Okay. Leave these entries. This is nothing. This is end of the time training. This is end training. Leave it. This is something else. Now let me make this table for you. Let me make these columns. We'll start from year one. Now amortized cost brought forward is 18966. In this question, what is the effective interest rate? EIR. Effective interest rate is 7%. Okay, EIR is 7%. Okay, now you have to help me out. So 18966 times 7%. 18966 times 7% is how much? 1327.62 less physical interest. We have already calculated 800. Now, my dear student, can you update the closing balance? How will you update the closing balance? 18966 plus 1327.62 less 800. How much? 19493.62. 19493.62. Okay. So the next, this is the closing balance for year one, and this should be the opening balance for year two. 19493.62 times 7%. Times 7%. 1365. Just doing little rounding off. Okay. Less 800. Come on, update the closing balance. 20058.62. 20058.62. Thank you. So this is the closing balance of year two, and obviously this will be the opening balance of year three. Now again times 7%. Physical interest is 800. Okay, take the difference. 20662.62. 20662.62. Please don't do any mistake, otherwise we'll all time will be wasted. Now this will be the opening balance of year four. Times 7%. 1446. Less 800. 21308.62. Okay. Now 21308.62 times 10, 7% times 7%. It should be, the closing balance should be close to 22,000, very close to 22,000. Yes, it is 22,000. Done. Done. And you know, we planned in the beginning that in the end we have to stop at 22,000. In the end we have to stop at 22,000. Okay, and we achieved our objective, so it's correct. Now you remember in all questions I proved you something. Let's calculate how much total cost we actually borne over the life of loan. How much is the total cost over the life of loan? We There were total four costs. The first one is redemption premium. Which was 20,000. Redemption premium was 20,000. Okay. Now issue cost was $534. Discount was 500. And how much was the physical interest? Can you tell me how much was the physical interest? Physical interest per year was 800. Redemption premium is 2000. I wrote 20,000. Sorry, my mistake. It's 2000 basically. Now, physical interest per year was 800. Per year, physical interest was 800. And multiply by 5. The total span was 5 years. So 800 multiplied by 5 is 4000. Okay. So now add all these. Add all these. 7034. This is the actual go slow. This is the actual total cost. Open your ears. This is the actual total cost for 5 years. For 5 years loan. Okay. Now let's see. Did we spread this cost over the life of loan? Let's see. Did we spread this cost over the life of loan or not? Did we spread this cost over the life of loan or not? Can you add this interest expense column? Can you add this interest expense column? Can you add this in interest expense column? 7034, yes, almost equal to 7034. See, we achieved our target. We achieved our target. Okay. Now wait. As the requirement says, prepare the financial statement extract. Financial statement means income statement and SOFP, income statement and SOFP. So now you tell me for every year, each and every year, just do it for 1 year. What amount will go in the PNL of year one? What amount will go in the PNL profit and loss for year one? This amount will go, in the PNL for year one, 1327.62. And which amount will go in SOFP at the end of year one? Which amount will go in SOFP at the end of year one? This 1949.362. And listen, this is a non-current liability. Strictly, this is a non-current liability. Don't forget this. This is a non-current liability. Why? Because this time the principal, just look at here, the principal will be paid after 4 years. We have to see principal. If principal is paid more than 1 year, then it's a non-current liability. Don't look at the interest. But in the leasing question, the last accounting standard IFRS 16, we used to split between current and non-current. You remember? Because in leasing question, listen, in leasing question, every year we were paying principal as well. Every year we were paying principal as well. So there was some portion of principal which we were paying within 12 months as well. That's why in that IFRS 16 we have to break between current non-current. But now the principal amount is strictly paid after 1 year or at the end of year 5. So it's a pure non-current liability. It's a pure non-current liability. Don't forget this. Now, just from now, as this is a very superhead standard, this is a very famous standard. Yes, at the end of year 4, it's a current liability. Year 4, because the year 5 is the end. Yes, at the end of year 4, it's a current liability. Everything is current liability. Thank you. Now, This IAS is a very super hit standard worldwide. Worldwide, it's a very famous standard financial instrument and a very technical standard. Although we are doing the basics of this standard, but the advanced level of this IAS is very, very dangerous. So that's why my strategy is to do final accounts as well. I'll teach you the final account portion of this IAS now as well as when we'll be going to the final account, we'll do it again. We'll do it two times. We'll do this topic final accounts question two times. Okay, this is my strategy, and this is very effective as strategy. In past, many students got benefit of this strategy. Even they gave me this feedback. Okay, so now, first of all, I hope you remember the three-step approach. The three-step approach. Three-step. When you were kids, you used to do three-step approach. What entries should have been made, what you did make, and what is the correcting entry. Or I should say correct entry, wrong entry, and correcting entry. Correct entry, wrong entry, and correcting entry. Okay. Now, can you see this issue cost? This issue cost. Can you see this issue cost? Issue cost is basically paid at the day zero. At the day zero, you remember the story? I paid issue cost to the lawyer. So the cash will be credited 534. The cash will be credited 534. And now just think, we are deducting, listen, we are deducting issue cost from our loan. We are reducing our loan by the issue cost amount. So loan will be debited. This is the entry. This is the official entry of issue cost. This is the official entry of issue cost. This is the official entry of issue cost. Right, but in past, it's a routine of final account. They made the account, they already gave you a wrong question. They already gave you a question with wrong treatment. So what they did, normally it is written in the question that accountant has charged the complete issue cost in admin expense. Now accountant has charged the complete issue cost as admin expense. So accountant made this entry, admin expense debit and cash credit. Now just think what should be the correcting entry. Can you tell me? He should have made the first entry, but he did make the second one. He should have made the first entry, but he did make the second one. So can anybody tell me what is the third entry, correcting entry? The third entry will be debit loan 534 and credit admin expense 534. Okay, credit admin expense 534. This is the correcting entry. This is the correcting entry. Sometime this thing comes in exams. Three-step approach. And don't forget, this is the official entry. This is the official entry of this is the official entry of issue cost. Official entry is this. This topic I taught you extra. These three entries are extra topic other than this question. Normal question I've taught you. Oh, sorry, I made one mistake. This is 534 as well. This is also 534. Sorry. Okay. Now I'm giving you one question for practice. I'm giving you one question for practice. but I won't teach you this. This is same as the last question. This is same as the last question, same duplicate. Just giving you one guideline that you start your amortized cost table. You start your amortized cost table with the net amount of cash you receive. Don't forget this. This is the basic technique for all questions with the net amount of cash you received. Okay, start it. Start this question, please. Now, just for a little help, I'm not going to solve it complete. The face value of loan note was 150,000. Okay, and how much was the discount? Discount was 10%, 15,000. So that means the net amount we received was 135,000. Less issue cost was 2,12455. So can you tell me how much initially we received? One, two, three. How much is the initial amount? Wait. 113,545. Let me confirm this amount. Wait. Sorry, this is the question. This is the question 11455. Issue cost is 11455. In that question it was wrong. This is the real question in my book. 11455. Let me correct it. Thank God. See, this is, see, I've just corrected it. It's 11455. In the question, issue cost was wrong. In the original question, okay, really sorry. So now it's 123,545. Okay, 123,545. Okay. Now we are directly moving to final accounts, the real final accounts question. Okay, do that question yourself. It's easy, not difficult. Now the final account question, and I'll teach you the techniques as well. The first thing which you must put in your mind is the accounting period. The first and the most important thing in all final account question is the identification of accounting period. The first step. See, it is on the top of the trial balance. The year end is 30th September X6. The year end is 30th September X6. Now just go 12 months back. 30th September X6 is the year end. So 1st October X5 is the beginning of the year. 1st October X5 is the beginning of the year. Okay. 1st October X5. This is your accounting period. 1st October X5 to 30th September X6. 1st October X5 to 30th September X6. This is your accounting period. Okay. Now let's read the adjustment. Normally the final account question is very big, but I'm directly teaching you the only adjustment of financial instrument. Okay, the only adjustment of financial instrument I'm teaching you. See, this is the adjustment, and please study properly. Can you see it? The loan note was issued. The loan note was issued on 1st October X5. Good news. On the first day of accounting period, our accounting period was ending at 30th September X6, and this is 1st October X5. That means on the first day of accounting period we issued loan. It is redeemable. It is redeemable on 30th September Y0 after many years. At a large premium, the future premium, in order to compensate for the low nominal interest rate. Nominal interest rate means coupon rate. That means the same issue. Right now we are paying small coupon rate. That's why in the end we have to pay. In the end we have to pay redemption premium. Okay. That means the effective interest rate is high and coupon rate is low. So right now you are paying low interest rate. So in the end you have to pay redemption premium. But they won't give you the amount. No need. The finance department has calculated the effective interest rate. See, it is given on the loan is 5.5% per annum. On the loan is 5.5% per annum. Now, my dear student, please don't sleep. I beg you, don't sleep. Don't sleep. In these three lines, have they written any word of issue cost? No, that means no issue cost. Did they use the word of discount? No discount. That means in every, the question which we were doing before was a very detailed question. The question which we were doing, the last question was very detailed. In reality, in exam, they give you very simple question in final account. So in this question, there is no issue cost, no redemption premium done. That means the loan note is issued at face value. The loan note is issued at face value. That means, use your brain. That means on the day one, we receive exactly the face value. We receive the cash. We receive the cash equal to the face value of loan on the day one. On the day one, I'm talking about the day one. Okay. So let's go to the trial balance. Let's go to the trial balance. See, this is the trial balance. It is written 2% loan notes, 2% loan note of 50,000. See, 2% loan notes of 50,000. Can you see? That means this 50,000 is the face value because this is the first year. This is the first year and we no discount and no issue cost. So this is the face value. And this 2%, don't forget, the interest rate which is just adjacent, which is standing just adjacent to your loan note, the interest rate which is just standing adjacent to your loan note is coupon rate. Okay, so now it's my request, can you calculate the physical interest? in 1 second. Can you calculate the physical interest? Quick physical interest. This is 50,000 times 2% is 1,000. 50,000 times 2% is 1,000. 50,000 times 2% is 1,000. Okay. But now I'll teach you with entries. I like this topic with entries. Okay. As this is only 1 year question, so entries are good. So now let's start. See, these are the 3 entries which I'll make. Look at here. Initial loan was 50,000 and your effective interest rate, I just told you EIR is 5.5%. Okay. Boys and girls, look at here. If effective interest rate is 5.5%. So for the whole year, we started the amortized cost table with 50,000 as there is no discount, no issue cost. So that's why we started the amortized cost table. You can call it amortized cost table with 50,000. Now 50,000 times 5.5%. 50,000 times 5.5% is 2750. Okay, this is the interest expense. Now you tell me how much physical cash we give, how much physical interest we paid. Physical interest was 1,000. So how much amount should be added in the loan? How much amount should be added in the loan? 2750 minus 1,000 is, okay, so this should be your entry. This should be your entry. This should be your double entry. This should be your double entry. This should be your double entry. Now, this entry they should have made. This entry they should have made. But listen to me now. It will take time. In final accounts questions, sometimes they solve the half question already. In final account questions, they solve the half question already for you. So this is the main technique that you recognize how much they have done already. This is the main technique that you should recognize how much they have solved already. Now go to the trial balance. They have already done something for you. They have already done something for you. See the trial balance. See the trial balance. All of you see the trial balance. See this thing. Can you see this? See this. Loan interest paid. Already they have made some entry. Already they have booked the loan interest expense. The physical interest is already booked in the trial balance. It can be it. We can see it from the trial balance that physical interest is already booked. So now that means they have already made this entry. They have already made this entry. Debit interest expense 1,000 and credit cash 1,000. Okay, so use your brain. The first entry we should have made, but the second entry we did make. The first entry we should have made, but the second entry we did make. Now what will be the third correcting entry? Now what will be the third correcting entry? Can anybody tell me what will be the third correcting entry? We should have booked interest by 2750, but we did book by only 1,000. So the remaining entry is and loan credit 1750. See the right tick. Now you will be awarded marks for this third entry. You will win this race. You will win this race by just posting this third entry. Now wait. 50,000 was the loan at the beginning of the year. 50,000 plus loan 1750 is 51750. That means at the year end you should bring your loan to 51750. At the year end you should bring this loan to 51750. At the year end you should bring this loan to 51750. Okay. Now teaching you one thing. Always do this thing. Always post this third entry and you will win the race. Just post this third entry in the TB. Let's do it. Let's go in the TB. How much is the see how much is the interest expense already? Interest expense already is 1,000. Just increase it by 1750. The third entry. In the third entry we debit the interest expense. So now just think, already the interest in the TB is 1,000. Already the interest in the TB, interest expense in the TB is 1,000 plus 1750. See, this is exactly 2750 now. This is exactly what we want, 2750. Now, what is the loan amount? What is the loan amount in the TB? It's 50,000 plus 1750 we credit the loan. So see, 50,000 plus 1750 is exactly 51750. So we achieved our objective by making the third entry. We just achieved our objective by making the third entry. By making the third entry. Have a look. Did you understand the question? Did you understand the question? You can check it again. You can check it again. Now, the second question. Now, our second question is this. This is the second question. Okay. Now, again, first of all, you need to check what is the year end. The year end is 30th September 08. Again, the year end is 30th September 08. If the year end is 30th September 08, that means go 1 year back. It will start, it is starting on 1st of October 07. So your accounting period is 1st October 07 to 30th September 08. Your accounting period is 1st of October 07 to 30th September 08, 1st October 07 to 30th September 08. Okay, that's very clear. Now read this adjustment. Read this adjustment. The preference shares. Don't worry. You know, there is one word, redeemable preference shares. I taught you in EPS and you did in your basic study as well. Redeemable preference shares are nothing but loan notes. Redeemable preference shares are nothing but loan notes. Redeemable preference shares are nothing but loan notes. Okay, so you can call it loan notes. Okay, the preference shares were issued on, see, very important, 1st April 08, mid of the year. Your accounting period is 1st of October 07 to 30th September 08. So these loan notes were issued right at the mid of the year. These loan notes were issued right at the mid of the year. Okay. Now at $1 each. Now that means at face value. At face value. What is the logic? There is no discount. There is no issue cost. See, open your eyes and read it. There is no discount. There is no issue cost. So that means these preference shares, these loan notes are issued at face value, number one. And the second thing is we'll start our amortized cost table with the same face value. We will start the amortized cost table with the face value because we receive the cash of face value. No discount, no issue cost. Now, they are redeemable at a large premium, which gives them an effective finance cost of 12% per annum. This is C. This is effective finance cost means EIR. EIR. Okay. So now we can easily go for the coupon rate. We can easily judge. We can easily find. Okay. This is the transaction. Students, please look at here. This is the transaction. Okay. Can you see? Your face value is 20,000. Your face value is 20,000. See the trial balance. Your face value is 20,000 and your coupon rate is 8%. Your coupon rate is 8% is your coupon rate. Can you see? But the one thing is very interesting. You issued the loan note on 1st of April 08. You issued the loan notes on 1st of April 08. That means exactly mid of the year. Exactly mid of the year you issued the loan notes. Okay. Yes, we'll do it divide by 2. Don't worry, don't worry. So physical interest in this question is 20,000 times 8%. For the whole year, physical interest is face value is 20,000 times 8% is 1600. Don't worry, I'll do it. Now let's solve it. Let's solve it. Now wait. Just think. What will be the interest expense in this question for the see the mid of the year? Can you see mid of the year? This is the year end. This is the border year end, and this is exactly midway. So your interest expense will be 20,000 times effective rate is 12%. This is for the whole year. 20,000 times 12% is the for the whole year times 6 by 12. $1,200 is your interest expense. Now let's calculate the interest paid. Face value is 20,000 times 8% times 6 upon 12 for the half year. Okay, so two things I have already calculated for you. Two things I have already calculated for you: interest expense and interest paid. So now let's make the three step very easy. Its three steps are very easy. Don't think it is a difficult thing. I will teach you many questions, don't worry. Interest expense is 1200, physical cash is 800, so obviously 400 will be added in loan. 400 will be added, and this entry we should have made. This entry we should have made, or you call it the correct entry, the first entry. Now let's see what examiner actually did. What examiner actually did for you. See what examiner actually did. See, see this preference dividend paid. Preference dividend. They call, as they have given the name of to loan, as they use the word preference share for loan. That's why for interest they are using the word preference dividend. Don't worry, for interest they are using the word preference dividend. So 800 entry they have already made. They have already booked the physical interest entry. They have already booked the physical interest entry, you can see. So the entry they have already made is the entry they have already made is interest expense debit and cash credit. So now you tell me, this is the first entry, this is correct entry. This is, they made it, they made this entry. And now what should be the third and correcting entry? Just think, what should be the third correcting entry, the real entry? It's interest expense debit 400 and loan credit 400. This is your third entry. This is your, no need to do cash. Why you are, cash is already done. Cash is already done. Oh, cash is already done, my dear. Okay, now let's do the magic again. Let's always, this is the third entry is the real entry, the correcting entry is the third entry, and by posting the third entry we always achieve the target. We always achieve the target. Okay, let's post it. Interest expense is basically preference dividend. The name of preference dividend, we are using the word interest expense. So now just see, I will simply increase the interest expense. I've just increased the interest expense in the trial balance. So 800 is already there. 8 plus 4 is 1200. 8 plus 4 is 1200, the actual amount which we wanted. And now your liability was 20,000. So you will increase your loan. Loan means preference shares in this question by 400. So it will become 20,400. Everything is done. Everything is done. That's the end of this question. See this. Next question. Next question. Let me enlarge the question for you. Wait. This is the trial balance. The first thing. Take your time, look at it. First of all, identify the accounting period. Do it, do it, do it. Simple. This is the easiest of all. This is the easiest of all. You remember the first case of today's class, the first case, you remember in the first case, there was no physical interest. You remember in the first case, the first question I taught you the topic which I started the class. This is the same. Now, can you see the year end is 30th September X3? And the loan note, see the second last line of the trial balance. All of you boys and girls, please look at the second last line of the trial balance. The loan is already 40,000. The loan is already at 40,000. Can you see? The loan is already at 40,000. Okay. Now let's read the adjustment. See, read, this is the adjustment. You read it. The 40 million loan note was issued at par. That means par means there is no discount, there is no issue cost. There is no discount, there is no issue cost. The first thing. Number two, at 1st October X2, that means at the beginning of our this accounting period, you just saw the end of accounting period was 30th September X3. You just saw that the end of the accounting period is 30th September X3. That means beginning of accounting period is 1st of October X2. Okay. So 1st October X2 to 30th September X3. We issued the loan on the first day of accounting period. Don't take tension. No, see the line, no interest will be paid on the loan. That means there is no physical interest at all. No physical interest at all. The first case which we did today in today's class. However, it will be redeemed on 30th September X5. 30th September X5 means after many years. For this number is irrelevant. 532400. This is just for this is just an imagination that we'll pay a big amount in the future. Obviously, we have to pay. Obviously, because this amount includes the redemption premium, giving the effective finance cost at 10% EIR. This is EIR 10%. Yes, this is relevant. So there is no physical interest in this question. Our amortized cost table will start from the face value, that is 40,000. Amortized cost table will start at 40,000 because there is no discount, no issue cost, nothing at all. Okay. And now just one entry you have to make. For the whole year, the outstanding loan was 40,000. For the whole year, the outstanding loan was 40,000 times effective interest rate, which is 10%. So your entry will be debit 4,000, interest expense, and credit loan, directly loan. There is no cash. There is no physical interest at all. So your year-end loan should be 44,000. That's it. Your year-end loan should be 44,000. Now, just for your explanation, this interest expense will go in the P&L. This interest expense will go in the income statement, sales, cost of sale, GP. After PBIT, this will go as a finance cost, right? And this loan entry will be posted here. This loan entry will be posted here. This loan entry will be posted here. See. Okay. So this was the easiest thing. This was the easiest thing. One of the easiest thing came in one past paper. There was no physical interest at all. There was no physical interest at all. Now this is one of my favorite question. It's a big question and I will solve it for you because there are some mistakes in this question as well. In the previous question, there were no mistake. They did half of the things and the remaining half things on you. But now you will see, now you will find some mistakes by them. Okay. So this is a very good question. It's a challenger for you that you have to understanding, you have to understand it. Normally students understand it, no issue, they do understand, but yes, it's a little bit different. But I have already taught you many questions, then I'm teaching you this. I've already taught you many questions. Now this, now it's turn. Okay, this is also a past paper. The name of the question is Dune. The name of the question is Dune, and the year end, my dear, is 31st March X4. The year end is 31st of March X4. That means the year start at 1st April X3. The year starts at 1st April X3. So can you see in your question? See this in your question. Wait. In your question, can you see in your question the loan notes is 20,000? The loan note is 20,000, and what is the coupon rate? Coupon rate is 5%. Coupon rate is 5%. Okay, so this 20,000, I'm telling you myself, this is the face value, and I'll prove it. So face value is 20,000, coupon rate is 5%. Face value is 20,000, coupon rate is 5%. 20,000 times 5% is 500. 20,000 times 5% is 1,000. Sorry, 20,000 times 5% is 1,000. So in this question, physical interest is 1,000. Okay, and don't forget the accounting period. Now I'm going to the adjustment. Okay, please be active, be active, be confident. You will win, you will win. Let's start. The 5% loan note, again they have told you the physical interest was issued on 1st April X3. Thank God, at on the first day of accounting period, at its nominal face value. See, openly he has told you, he has openly told you that we have issued loan note at face value. Okay, and that is 20 million, that is 20 million. Okay, now the direct cost of the issue were 500. See, now in this question there is a issue cost. In this question there is a issue cost. But what this stupid guy did, what this stupid guy did, see, and these have been charged to administrative expenses. This guy immediately dumped, immediately booked the complete issue cost in PNL. This is very bad. See, he did one mistake, he did big mistake. So now let's do it with entries. Let's do this problem with entries. And I have taught you, I have I have taught you this thing earlier. I have taught you this thing earlier with in my question. Now wait. Three step. What entry we should have made for for issue cost? For issue, as issue cost is paid in cash, as issue cost is paid in cash at the beginning. So cash credit, and we reduce our loan. We reduce our loan by issue cost. So the entry is loan debit and cash credit. I told you the official entry. But what he made, this stupid guy made the entry admin expense debit and cash credit. This guy made the entry admin expense debit and cash credit. So the first entry he should have made, and the second entry he did make. So what should be the third entry? The third entry should be loan debit and interest expense credit. Don't forget, I'm right taking it. That means this is the entry which should be post. We should adjust this entry. We should adjust this entry in the trial balance. Okay, this is the first thing. Now this question is a normal question, routine question. This is how we do it. The face value was 20,000, and you remember initially I told you in many questions, we always start the amortized cost table. We always start the amortized cost table with the net cash we have received. So we issued the loan at face value. So we received face value of 20,000. But immediately we have to give 500 to the lawyer. So 500 is the issue cost. So the net amount of cash we received is 19,500. Use your brain. The net amount of cash we receive is 19,500. The net amount of cash we received is 19,500. Okay. So if you are doing with 4 columns thing, then you will start your amortized cost table with 19,500. But right now I'm not doing with that 4 column thing. I'm doing with entry. So I'm writing here the beginning amortized cost is 19,500. The beginning amortized cost is 19,500. My dear student, what is the effective interest rate? EIR in this question, you can see it's 10%. So now in this first year, what you will do, the outstanding loan is 19,500. The outstanding loan for the whole year is 19,500 times 10%. So interest expense is 1950. Interest expense is 1950. Now I'm going to give you a biggest dodge. You will be shocked. I'm going to teach you something new. Normally in 90% questions, we pay the physical interest. In 90% question, we pay the complete physical interest of 1,000 immediately. See, so the cash we pay is 1,000, and the remaining amount of 950, and the remaining amount of 950 is booked as a loan. Okay, this is the routine thing we did in every question. Interest expense is 1950. Physical interest I already calculated with you was 1,000, and the difference will be added in loan. But wait, this entry we should make. Now just see, sometimes examiner makes the physical interest entry already, sometimes not. We did 2 questions, 3 questions. Examiner is the habit of examiner, that they already record the cash entry in the trial balance. Okay, now let's go to the trial balance. You will be shocked. Don't sleep, please. Let's go to the trial balance. Something new is waiting for you in the trial balance. Something new is waiting for you. Can you tell me what is the amount of, see how much interest is paid? How much interest is paid? Only 500 interest is paid. Actually, in reality, we should have paid whole 1,000, but we only paid 500. That means this is something new. 500 is accrued interest. 500 is accrued interest, current liability. See, by the year end, we have only paid 500. The actual amount of physical interest is 1,000. That means we'll pay after 1 day, after 1 day, after 1 day. This is current liability, a new thing. See, this is the dodge. This is the level of F7, FR. So now let me rub it. See, this. The original entry should have been interest expense debit cash credit 500, and the other 500 is accrued interest. This is the new thing. Other 500 is accrued interest. Yes, accrued interest is possible. Yes, accrued interest is possible. Sometimes we pay the physical interest after the year end. Sometimes we pay the physical interest after the year end. This is also possible. Okay, so this is the first entry that should have been made. That should have been made. But what entry they already made? Only 500. They already made this entry, my dear students. Okay, okay. Now what is the third entry? Now what is the third entry? The amount of interest that should have been booked is 1950, but that the we did book only 500. So now we should have booked 1450. Interest expense, accrued interest is 500, and the loan amount is 950. Okay, so this is one more right tick entry which we have to post. This is one more right tick entry which we have to post. This is one more right tick entry which we have to post. See, on the two entries, there are two entries on which I made the right tick. Two entries on which I made the right tick. Now wait, you credit the loan now 950. You credit the loan by 950. Originally the loan was 1950 plus 950. Can you tell me 1950 plus 950? 1950 plus 950. What should be the year end loan? The year end loan should be 20450. The year end loan should be 20450. See, 1950 was should be at the beginning, amortized cost beginning, and plus 950 is 205450. So our objective is to bring your year end loan for to 20450. Now let's post it. The first entry is loan debit or interest expense, admin expense credit. So loan debit means we'll reduce the loan by 500, and we'll reduce the, where is the admin expense? This is the admin expense. Wait, we'll reduce the admin expense by 500. Okay, the first thing. In the second entry, we debit the interest expense. So interest expense is already 500. We'll increase interest expense by 1450. See the magic, interest expense already in the TB is 500, and we'll increase it by 1450. So automatically it will become 1950. See, our objective is achieved. And then the loan credit by 950. Loan increase the loan by 950. Now do this magic, your original loan note was 20,000. See the screen. Your original loan note was 20,000. What I just did, minus 500 plus 950. Do it, please. All of you, please do it. 20,000 minus 500 plus 950. 20,000 minus 500 plus 950. Our loan is exactly at 20450. Our loan note is exactly at 20450. That the amount which was achieved, which we wanted to achieve. I taught you in the sketch. Okay, and now finally, don't forget to post accrued interest in the balance sheet. When you make the balance sheet, you have to post accrued interest in current liability. When you'll be making the balance sheet, you have to post accrued interest in current liability. I hope you understood the question. It's a difficult question. I recommend you to revise it after the class as well. I recommend you to revise such questions after class as well. Did you understand the question? Now, the next question is Quincy. The next question is Quincy, same as, but there is no, I think there is no accrued interest in it. It's easy. It's easy. Come on, do it. I'm giving you chance to do it. This is the only adjustment which is relevant. See, year end is 30th September X2 and do adjustment number 2. Do adjustment number 2. I have tried to enlarge the question. I have tried to enlarge the question. Okay, start it. Come on, come on. You have 3 to 4 minutes. You have 3 to 4 minutes. I'm giving you 3 minutes. Okay, let me do it. Let me do it. 30th September X2 is the year end. 30th September X2 is the year end, so the year beginning is 1st October X1. Now, this is your loan note. This is your loan note, okay? So, face value is 25,000, coupon rate is 6%. Coupon rate is 6%. So, 25,000 times 6% is the physical interest. 25,000 times 6% is the physical interest. Now, let's see what is written in the notes. This is Quincy issued a 25 million 6% loan note on 1st of October X1. So as there is no word of discount in it, so there is no discount in this loan note. There is no discount. The loan note is issued at face value 25 million. We receive the cash. Now, issue cost were $1 million, and now see, this is stupidity. And these have been, it's easy now because you have done one question, these have been charged to the administrative expenses. See, he did the same mistake as it was in the last question, so let's correct it. Now we are expert. For the issue cost, what entry we should have made? We should have made loan debit 1000 and cash credit 1000. Okay, issue cost is basically reduced from loan, but what entry this guy made? This guy made admin expense debit and cash credit. So what should be the third and the last correcting entry? It should be loan debit by 1000 and admin expense credit by 1000. This is the first entry. This is the first right tick entry which I should make. And I did it. Now it should, now you must know all these things. Now, wait. The face value was 25,000. Now let's solve it like normal way. We received the cash 25,000 and now immediately on the day one, we paid the issue cost of 1,000. So the net cash is received 24,000. This is from where we'll start our amortized cost table. We'll start our amortized cost table by 24,000. We'll start our amortized cost table by 24,000, the number. Okay, let me do it. Let me do it in this way we are used to with this. 24,000 is the opening loan. Now what is the effective interest rate? Let me check. The effective interest rate is 8%. Yes, this is 8%. So 24,000 times 8%. 24,000 times 8% is how much? 24,1920. So debit interest expense by 1920, and physical interest, if I'm not wrong, is 1500. Physical interest is 1500. You remember 25,025,000 times 6%. So how much will go in the loan? The loan amount is 420. The loan amount is 420. The loan amount is 420. Okay. So this entry we should have made, but now let's see. I've already told you, if you see the trial balance, the cash entry is already been made. The cash entry in the 99.999% questions, the cash entry has already been made. See how much cash entry is there. How much cash entry is there? Now one more dodge. Don't worry. Loan note interest and dividends paid. Listen, this is 20,000. In this 20,700, in this 20,700, already the interest expense is included. The physical interest is included in it. The physical interest is included in this 20,700. Now in this question, they have not given you separately, but yes, they have written in English. See the statement, loan note interest is included in 20,700. Okay, so that means examiner has already made the entry loan interest expense debit and cash credit. Now what should be the last entry? The last entry should be interest expense debit 420 and loan credit 420. Interest expense debit 420 and loan credit 420. Interest expense debit and loan credit 420. Okay, so my dear respected students, just two entries you have to post. The two entries on which I did right tick, just post it and you will get full marks. Just post these entries with right tick and you will get full marks. I've taught you now. I have taught you the issue. I have communicated you the issue. Even I'll teach you these things again, but please don't forget on that final account date. Okay, this is just for your confidence that I'm teaching you right now this thing as well. You did right. Very good. Okay. Okay, do this question as the last question. Candy. Again, this is same. It's not difficult, the same thing. Try to do it. Okay, let's do it. The accounting period ends at 30th September X4. You can see 30th September X4 is the year end. So definitely the 1st October X3 is the beginning of the year. 1st October X3 is the beginning of the year. Okay. Now, how much is the loan? The loan amount is 30,000. The loan amount is 30,000. The loan note was issued on 1st October X3. That means at the first day of accounting period, an incurred issue cost of $1 million, which were charged to profit and loss, P&L. Okay, admin expense or P&L, same thing. Again, he did this mistake. See, these three entries for issue cost. What is the entry? What should be the entry for issue cost? It's 1800. Loan debit 1800 and cash credit 1800. But what this guy made the entry? P&L debit, expense debit, and cash credit. So what should be the third entry? The third entry is loan debit and P&L credit 1800. Okay, this is for issue costs. This is for issue 1 million. It's 1 million or 1800. Oh, sorry, 1 million. Sorry, really sorry. Oh, this is 1 million. I wrote it wrong. Sorry. Okay. So now this third entry will be post in this question as in the part of retain earning. In this question, this is a different final account question. So right now we are not doing the complete question. So this PNL is enough. Okay. Now let's solve it in a normal way. The initial face value was 30,000. There is no discount. Nothing is written about the discount. So initially we received 30,000 and we paid 1,000 as issue cost. So 29,000 is the amount by which we'll start. 29,000 is the amount by which we'll start our amortized cost table. So let's start the amortized cost table. Initial amount is 29,000. What is the effective interest rate in this question? Effective interest rate is 9%. Can you see? Yes. So 29,000 times 9%. What is the amount? 29,000 times 9%. Very good. 2610. Physical interest is, I think, 30,000 times 600% is 1800. 810 should be included in loan. Okay, so this is the first entry we should have made. The first entry we should have made. But what entry? What entry? Sorry, what entry he already made? What entry he already made is 1800. See, 1800. The physical interest entry is already been made. Okay, so tell me the third entry. Tell me the third entry, tell me the third entry here. Tell me the third entry here. It should be 2610 minus 1800 is 810 and 810. That's it. So almost all major questions are same. Majority questions are same. Majority questions are same. Please have a look. Okay, did you did you do it correct? Okay, that's the end of today's class. It was a longer lesson, sorry. But yes, it's a big standard, so we need to make more efforts on it. Okay, please practice it after the class. Practice it after the class. Don't lose hope. You have to do it very good. Thank you.